I was on the 50th floor of that building when we had an earthquake. And I was in another earthquake, the Northridge one, when it was a 6.5. These are wicked numbers, just awful. 6.5 on the Richter scale is a very bad feeling. 25, I don't think has ever happened. And that's how serious I think this is. And then just to your point about all the volatility, I think that, you know, what people who are in the economics field would turn back and say to you is, well, look at the price volatility of Bitcoin, you know? So you understand what I'm saying? They're saying, how can this be digital gold when the price is so volatile? Well, even the gold price is very volatile in that context. But in the Greenspan years, just to finish this off, since I lived this history, during the Greenspan years after Volcker, you can tell now that what he did, you know, he was a follower of Ayn Rand, and what he did was use the gold price as his guide. And he wanted a flat gold price, and by golly, it was. And to achieve that stable price level, which is what the Fed is trying to do, preserve purchasing power, the Fed funds rate was very volatile. But I must say, and he never told us he was doing this, but if you look at the history...
Cathy Wood and Balaji Srinivasan agree on one thing: Bitcoin is going to hit $1 million. However, what they disagree on is the time horizon in which it is going to get there. Cathy and her firm at ARK Invest believe it will take 7 years with Bitcoin hitting $1 million by 2030 as more and more institutions add it to their balance sheets and investors look at it as a safe haven asset. Balaji, on the other hand, believes that due to the loss in faith in the banking crisis and hyperinflation, Bitcoin will hit $1 million in the next 90 days. He points out that every fiat currency in the history of the world has eventually been hyperinflated into nothing, and Bitcoin can serve as an insurance policy and a flight to safety against the confiscation of wealth. Overall, the conversation revolves around the potential for Bitcoin to reach $1 million in value and the different reasons behind how they can arrive at this forecast. Despite differing opinions and perspectives on the matter, Cathy and Balaji both agree that Bitcoin's value proposition is strong and they seek to uncover the truth behind its potential for growth. Through their discussion, they highlight the importance of understanding market signals and the need for leaders and a central bank who can respect and respond to these signals appropriately. Before we jump into their points, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
Now, I remember Art Laffer collaborated with us on our first Bitcoin paper in 2015. It's when we first gained our exposure to Bitcoin at $250. And when we were writing the paper, you know, do you know who Art Laffer is?
Yeah, the Laffer curve, basically, where he kind of, it's funny because it's a completely obvious point that at 0% and 100% taxation, the state gets no revenue.
Exactly.
And that there's at least one optimum in between. It's essentially like the mean value theorem.
Mm-hmm.
But go ahead.
So when we were writing the paper, he said, I have been waiting for this since we went off the gold exchange standard in 1971, a rules-based monetary system, a global rules-based monetary system. And I love it. But what he said is, I love the rules, the rule, but if you want price stability, you need a price rule, not a quantity rule. If you want a store of value and you want appreciation, then a quantity rule is fine. So from a monetary policy point of view, and I've often wondered this, I'd love to get your thoughts. Let's say you are right and Bitcoin, takes off. And we have the same price target. It's just ours is more like
the timeline.
2030, and yours is, and I know you're saying it for effect, just to get people to understand.
It's directional. That's right. It's basically, okay. So actually, go ahead, finish what you're saying, and then I'll jump in.
So, yes. So much like I described Greenspan and the gold effect, he was on the gold standard, but nobody knew. He was managing money to gold. Art thinks that we need that. And he said, but they'll get it right. They'll get it right. Now, remember, and in terms of his credibility, his mentor was Robert Mundell, who won a Nobel Prize for monetary economics. So he's not only a fiscal policy expert, but also a monetary policy expert. And so what I have been wondering all of these years is, let's say you're right. I actually think our research, the building blocks of it, you can see in Big Ideas 2023. I don't know if you've seen it, how we get to that 1 million plus by 2030. And I've been wondering, let's say it takes off and it just goes parabolic, and there's no incentive for anyone to let go of any of it. It's just, right? Why would you? Every time you do, you lose money. And so you get into that mindset. And then in a way, it's from a monetary policy point of view, in terms of managing the economy globally, you're off the rails. You have to figure out a way to get to a price rule. And so I have wondered, I think the answer is absolutely not, because I have met with the core developers and I know how strongly they feel about the quantity rule here. But can you imagine any circumstance where Bitcoin actually loses its usefulness in a sense? Nobody wants to use it for anything. They just want to hold it. What happens then, right? If you're trying to manage an economy around Bitcoin. What I have found fascinating about this period is many people had their money in deposits at the bank. And this crisis actually has forced them to focus on what they're earning in the banks versus what they could get into money markets. And so
yes, they've all become yield farmers.
Well, not only that, and isn't that something? So you see them in their minds, what they're saying is, I am going to lower my risk by leaving the banking system and increase my return. Now, isn't that upside down? That's not how the world works. And this I worry about from a bank deposit point of view. And the reason for this is lending. And ultimately, lending is going to shut down. And then you were right by starting out with a held to maturity. We don't have to go through that. That has been studied, and I'm sure a lot of people know about it. But what people have talked about, available for sale, you mark to market right away for that, quarterly. So that hits earnings. Held to maturity, if you sell those, it hits equity. But what they're not talking about is the rest of the asset side of the balance sheet of these regional banks, and it's real estate.
Yes, exactly. They're getting crushed on everything. Yes. Yep.
Commercial real estate, 75% of real estate loans out there are, if they're from a bank, are done in the regional banking system. And I would submit that that residential will be hit in another way, because there has been so much overbuilding with the capital markets now facilitating this of multifamily homes, that we have now coming online the largest number of apartments in 40 years. So we were going back to the 70s, which was, so when I look at that, I said, okay, that was real estate speculation. That was inflationary. But I do think that rents will now come down dramatically, velocities coming down. And I, again, worry about GDP and economic activity.
Right. So have you ever seen like a flock of pigeons, and then like somebody, they throw bread or something and the whole thing just takes off at once. All of them take off at once, right?
Yes.
You've seen that? I'm sure you have, right? That is my mental model for what has happened. The combination of fear because, it's not just SVB, it's essentially like tech elites, financial elites. Now the conventional wisdom is cash is a risk asset, right? Friedberg actually said that. Because all these people were very condescending and ridiculous around the time of SVB. They're like, "Oh, what? You didn't have 10 bank accounts? Oh, you didn't know your money wasn't safe at the bank past the FDIC limit?" Well, actually, what the more sophisticated argument is, you would have thought that all the regulation that you paid for would have given you a heads up about the literal insolvency of your bank when the bank and the bank regulators were clearly aware of that. I mean, you can dig into the footnotes over here. And look, I feel like SVB is not unique in this. A bunch of banks effectively got killed by the Fed with these surprise hikes. Basically, here's, Michael Green, who I don't agree on Bitcoin and so on, but some evidence of deception by SVB management. Basically, the way I think about it is the Fed surprised the banks. The banks, oh my God, what are we going to do? They decided to, go and surprise the depositors. Basically, anxious bankers wondering what they should do in reaction to large losses. Answer, hide it, right? They go and hide it in footnotes. They hide their literal insolvency, okay, in a footnote. And, they do things where, like, item 6 reserve, they used to break out their hold to maturity securities. Point is, if you go through a bunch of bank 10Qs, you can probably find some evidence of, quote, deception where they disclose, but they don't really disclose. I mean, you have on every website, EU regulators make these cookie pop-ups, okay? But on the bank website, you're not told the bank is insolvent or could be insolvent, all right? Now what's happened is we've all gotten the message. Every single tech CEO, which is actually an influential sector of the economy, amidst all the yelling and screaming, has gotten the message that your funds aren't safe in the bank. You are not going to get a heads up from bank regulators if the bank is insolvent. The bank is not going to tell you. They're going to hide it in some statements. It could be insolvent for many reasons. It could be insolvent because of, them buying treasuries. It could be insolvent in terms of a write-down of their loan book. It could be insolvent because of some opaque derivatives thing that who the heck even knows, even at the bank, if they're actually dead without knowing they're dead. It could be dead for many reasons. You will not be told whether it's dead or alive. It is Schrodinger's bank, okay? Where it exists in this quantum superposition. You can go and look certainly at studies like this, the Stanford study of, banks, where basically they do think that lots of banks face the same risks, and you can look at their model and they think there's 2 trillion losses. But once you start seeing numbers like 2 trillion in losses, many banks, when you see FDIC itself, for example, say most banks have unrealized losses, right?
So can I stop you there, Balaji? Because
Yeah.
I want to make sure that we don't set off unnecessary fire alarms. So can I just set this up and say, you are right. This is an indictment, not own. It's the indictment of certainly. But the bank analysts, where were the bank analysts? They read the footnotes. They know hold to market. They know all the rules of the game. But just so we understand, banks always have a mismatch in their durations. That's what makes it a bank. So their assets are long-term. Their liabilities, which are deposits, are short-term. They can leave any time. And so the issue is that held to maturity is part of the asset base. Is money good if they hold to maturity? And when they buy those, look, in COVID, when they were getting gushers of deposits from the stimulus programs, the Fed basically said, okay, the risk here is a depression. And if you look at their forecast through 2023, the end of this year, they showed no increase whatsoever in interest rates. Okay, so these bank officials are making decisions saying, okay, then I will put my money in this government-backed mortgage security, and I'm planning to hold it to maturity. The problem was, and they would have, and banks typically do. Silicon Valley Bank allocated too much to held to maturity. That's one point. But the more important point is they never expected a venture funding drought, the likes of which we haven't seen in quite some time. And they didn't expect a 20-fold increase in interest rates. As you said, it went vertical and the expectation was quite different. So that, each of those mistakes is understandable. We've never had a 20-fold increase in interest rates in 1 year. In fact, I don't think we've had a 20-fold increase in interest rates ever, right? And we have not seen but deposits leaving the banking system like we see now since on a year-over-year basis since 1948. And we have not seen M2 decline. It's down 3-ish% now. We have not seen it decline since the Great Depression in the 30s. So it is understandable. They did not expect these black swans, but these black swans occurred. And so I'm just trying to put in perspective, you know, I've watched the banking system all my life. I've watched this mismatch all my life and seen these two assumptions that they made. Interest rates wouldn't go up hugely, you know, certainly in the last 40 years, and deposits wouldn't leave the system. So this is a very unusual time. But I think if you really want to blame someone, you blame the Fed.